Hey everyone, welcome in to a special Sunday daily editorial here on the KE Report. We're chatting with Marc Chandler. We're going to be following up on some of the market moves last week that Marc actually gave us some insights on in the week before interview, as well as look ahead to what is going to be a pretty crazy week coming up with a bunch of central bank meetings and some key U.S. economic data. Marc is the managing partner at Bannockburn Global Forex, also editor of the Marc to Market website, which I will post a link to in the show notes. Now, Marc, overall, last week when we chatted, you came on and outlined some targets for the S&P, for the NASDAQ, even for gold that were generally lower. You saw some weakness coming into the markets. It's what we saw this last week. The small cap's still doing fairly well, but we saw a little meltdown in the tech sector and just broad weakness in a number of areas. Where are we now, Marc? Was that enough of a washout in your eyes?
Yeah, I think it's in the market. Sometimes it's better to be lucky than smart. And I think that we did have that sharp sell-off that's in the stock that sort of looked like it ended yesterday. But here's what I'm looking at. On Tuesday, we gapped lower in the S&P 500, and you could use your search engine and look for gap theory. I think this is like old school thinking about the markets that just like nature abhors a vacuum, so does the market and prices, and so those gaps where prices don't trade become important. And so I'm looking for the S&P which is now at highs of the day near 54.85. I'm looking for something around to basically fill that gap that we created earlier this week. That gap goes from about 55.08 to about 55.50. Now, I'm still concerned that this is just part of a larger correction still, but at least initially next week, look for a little bit firmer price as we try to fill those gaps. Uh, I think that the same thing like in gold, we were talking about the 2350 area in the spot market. We got down to about 50, almost 50 to 2550, actually 2350. But now it looks to me like maybe we're headed back up a little bit. Maybe got to test that 2425 area. But I think that the markets are giving us a lot of conflicting signals right now. As the market's pricing in, not a Fed cut next week, but about a 10%, a little bit more than a 10% chance of a 50 basis point cut in September. Sounds like they're expecting a very soft inflation or soft jobs data that gets the Fed to go take such a big step at first. But when you look at what the surveys are looking for next week's jobs data, it's about 175, 180,000 on non-farm payrolls, with the unemployment rate remaining unchanged at 4.1%. So it's not the kind of things I think that would justify a 50 basis point cut initially. So I think that's why the market's giving us like some conflicting signals, but there's a lot of cross currents. And one of them, of course, that we were talking about off mic is a big short squeeze in the yen. The market had been, of course, selling the yen. The yen had hit something like 35-year lows or something like that, lowest in a generation. And it's reversed. And in the last 2 weeks or so, the dollar has fallen almost maybe a little bit more than 6% against the Japanese yen. And as people bought back the yen previously sold, right, what really happens, I think, is retail investors like myself, we buy an asset because we think it's going to go up. But the large pools of capital don't think like that. They don't use their money, they use other people's money, OPM, which means that they would borrow the yen, then sell the yen, and buy some other better performing, hopefully, asset. And that is in the currency markets, it's been like the Australian dollar or the New Zealand dollar or the Mexican peso. But maybe there was also something where people had bought S&P 500 or the NASDAQ and sold the yen against that. So as people unwound these structured positions, we saw like a rippling effect through the markets. I think the Aussie is having one of its worst weeks of the year, off more than 2%. Same thing with the Mexican peso, which was the favorite candidates for these carry trades. So as this yen short squeeze rippled through the markets, I think you see some of the effects of it. We're getting some stability in the yen today. I suspect that the surge, the panic squeeze might have ended, but no one's going to, I don't think people are going to really be eager to take on new positions ahead of the Bank of Japan meeting very early next Wednesday.
Yeah, Marc, it's been interesting to watch kind of the fallout from that carry trade in the yen unfolding and causing certain assets to be sold down. It tied into some of the market weakness we've seen for sure. But in general, we were talking about the economic data, and people are looking ahead to what central bank policies will be. You brought up the jobs data that we're going to be getting next week and also looking at inflation. But we were mentioning off mic before this call that when you actually think about it, a couple of years ago, the economic data was a little more dire. We were seeing two negative quarters of GDP. We were seeing banks fail last year in 2023 with the regional banking concerns. We were seeing manufacturing take a hit and go below the boom bust cycle of 50. So we were seeing a lot of weakness in the data. Lately, we just saw the GDP number come in at 2.8% growth, beating the estimates. We've seen inflation taper down into the twos, almost to the point where the Fed could take a victory lap. We're seeing the real estate market pick up. We're seeing the bond markets pick up. I'm having a hard time seeing the hard landing or the recession that we've been expecting for the last 2 years showing up anytime soon. What do you make of the economic mix of data out there, Marc?
I think you're right, Chad. This is a very unusual business cycle with COVID, the uneven impact, the uneven reopening, the supply chain disruptions hitting different parts of the global economy differently. Then you get the Russian invasion of Ukraine, and then you get the de-risking with China. So a lot of things make this business cycle. I know we're all snowflakes, and every business cycle is unique, and we're all unique. But there are some like regularities, and I think that what happens, I think, is that we finished this huge expansion, helped juiced up by monetary and fiscal policy. And now it's really a question of what's happened to the business cycle? Is it still intact? And there's a lot of indicators that typically work in past recessions, like leading economic indicators or inversion of the yield curve. Everybody's got their favorite thing. What I've been watching is the length of unemployment rising. How long people are unemployed in the U.S., steadily rising to levels that also we typically don't see outside of recessions, or some consumer credit stress levels, auto loan defaults, so the credit card default. And so these are worrisome signs. And so I think that's why the Federal Reserve next week is going to lay the groundwork, confirming what the market already thinks it knows, and that is that a rate cut's coming in September. And the reason the Fed can cut rates is because inflation has softened, and they have some doubts about the economy. That is in Powell's like language, the Fed's language would be something like the risk, the balance of risks between the two mandates are now better in balance, and so the Fed can now can take some action. Now that inflation's eased, they can take some action to try to ensure a soft landing to the real sector. And I'd say that the market is really say that. Of course, it's like hard to know what is the market. So I look at the surveys, and the surveys don't show the U.S. economy contracting. They have the economy growing basically near trend. And by trend, I mean what the Federal Reserve says is the long-term non-inflationary growth level for the U.S. economy, which is around 1.7, 1.8%. And in order to get inflation down, theoretically, you've got to grow less than your growth potential, less than trend growth. And the market's got, after, as you mentioned, Chad, you had 2.8% Q2 growth annualized, and the Bloomberg consensus for the next 2 quarters is 1.5%. That's still in line with the soft landing. I'm a bit more concerned, not so much for this year, because typically the U.S. does not have a recession in a presidential election year. There are some exceptions, like 2008, a very unique case, as the great financial crisis, and then 2000, and I think it was what we get after the financial crisis, maybe 2020 with COVID as the two big exceptions to that. Typically, the recession comes in the first year of the new person's term. And typically, the stock market does not sell off in the fourth year of a presidential term. So I think that these kind of patterns still hold. And of course, it's always hard to know when a recession is coming because it's not like the economy just slows down and then it bleeds over to recession. Sometimes it's more of a V-shaped. It's sort of like, imagine what consumer confidence is. The economy is booming and consumer confidence is very high. And then when the recession hits, that's when the recession hits. It's not when consumer confidence is very low, but when consumer confidence is very high. So I don't think that, say, Q2's economy is really telling us what's going to happen the second half of this year or the first part of next year. So I think that the prudent thing, I think, is where the market's pricing in right now that the Federal Reserve begins an easing cycle, 50 basis points or so this year, and another 50 basis points in the first half of next year. I think that's just prudent as the economy softens or as we lose a little bit of momentum in the labor markets and price pressures ease to give the Fed some more breathing space.
I find this also interesting because even you were on the show a couple of years ago when the data was worse, saying it doesn't seem that bad. The economy does seem okay. And now you're coming on the show saying, look, even though the data looks okay, you go underneath the surface, some of the things that you pay more attention to, you do see potential recession coming or this weakness maybe continuing, picking up steam. If the Fed is going to start cutting rates in the next couple months, let's say, in your eyes, are they behind the curve? Are they timing this well? And can rate cuts help to stabilize an economy that you see as continuing to weaken?
Yeah, that's an interesting question. So yeah, I guess if I had to, like, if I was at the Fed, I'd probably be doing what they're doing, and that is preparing to cut rates. Is it too late? I don't know. I mean, I think that 25 basis points or even 50 basis points we might get before the end of the year, is that enough to avoid a harder landing? I'm not convinced it is. Partly the way that we're talking about when you or I buy something, we buy a pair of shoes, we buy a suit, we know that we're paying a retail price. And money, I think, works the same way. There's a retail price for money, there's a wholesale price for money. The wholesale price for money is what banks charge each other, about 5.5%. The retail price for money is what my credit card is charging me. They want 23% or 22% in an annualized rate. And so just because the Fed cuts, it doesn't mean that us consumers are going to really benefit from it for a while. That said, I think maybe to Shad's point, with the real estate market, we have seen mortgage rates ease, and we have seen some of the pressures in commercial real estate ease as well. To me, that's still not the makings of a recession. It just sort of compounds things. So I think if I was in the Fed, I'd be really pretty much doing the same thing, preparing to ease policy in the last part of this year and into next year on the back of that softer inflation and trying to ensure we get that soft landing. And I think you're right. You guys talk to a lot of economists, and we used to think you get two economists, you get three different opinions. And so I think it's a bit like a Rorschach test. What are we? You look at all these economic data, you look at all these anecdotes, you look at facts, you look at sentiment, and what shakes out of that, I think, is partly a Rorschach test. What you sort of it's true to your priors. But I think that, like I was saying with Shad, I think the business cycle is unique. It's hard to figure out. And I think we just have to do the prudent things, which I think is, and that's what I talk about with trading, is that it's not about getting it right. People who make money in the markets don't get things right more often necessarily. What they do is they're better at disciplined risk management, cutting the losses. I've worked with a lot of traders, and the typical thing is make a little money, lose a lot of money. Make a little money, make a little money, lose a lot of money again. And it's really about that disciplined risk management, reducing those drawdowns.
Man, Mark, that's such a great point because it's not how much you make, it's how much you keep, as the saying goes. But I'm curious to get your thoughts on, you mentioned the housing industry. We talked about consumer confidence. A lot of people have mentioned higher for longer is great for people because it rewards savers. Now people can make 5.5% of their money market account and make a little money to save, and they don't have to be invested in the market so much. But if the rates start coming down, two questions. Does some of that money find its way back into the market to get a better return if they don't make so much in their money market accounts and rates come down? And the second thing is, have people made enough in those accounts to offset the higher prices we're seeing? Because higher for longer is, hey, inflation may be sloping down as a trend, but that's after several years of really bad inflation where prices are considerably higher than they were just 4 years ago. So is the consumer eventually impacted by this higher for longer, or have they outpaced it by being able to save?
Yeah, so I think that for me, the key really isn't looking at consumers in aggregate like that, because of how like significant the maldistribution is in the U.S. Most American households, I believe, are net debtors. That is to say that they pay more interest than they're getting back, whether it's on their 401ks or whether it's their money market accounts or what have you. So I am concerned that I'm concerned that the lower interest rates, I think it hurts is also businesses. Usually we think about businesses as being net borrowers of money from the banks or from net borrowers either from the banks or the markets. And yet corporate America really has a surplus that offsets the deficit of the government sector and the household sector. So corporations are net interest beneficiaries. They receive net income. Households, I don't think do. It's given the high indebtedness and the high interest rates. So, but I think that to your point, though, what's going to happen? So interest rates fall, and people like myself will take money out of our money market accounts, out of our T-bills, and buy stocks. And the question is, where do we show up? And that's why I'm looking at like the S&P 500. And even though we held more or less 5,400, I think where it's good value, over time, it looks to me like value has come around the 200-day moving average. And the 200-day moving average is just below 5,000 right now in the S&P 500. So that's still 8% away or so, almost 9% away. So to get me out of my money market where I'm getting, I think my 4-week T-bill is getting about 5.3% right now. And for me to get into the market, I need to see a sell-off deeper than we've seen. And I'd say we've gone from about 56.70 down to 54, so 200 points. I'm saying that can't tempt me for another like 400 points, closer to 5,000.
So, Mark, since this is also what seems to be a global phenomenon, most central banks are cutting rates, even if, fine, you don't want to get into some of the larger indexes, but there is this rotation trade. The globe is doing it. What does that signify to you?
Yeah, no, I think you're right. It is a global phenomenon. And just to your point, I mean, the Japanese stock market was doing so well when the yen was weak. And this week alone, the Nikkei is off almost 6%. And that's really one of the worst stock markets. The other one that's been hit by tech and by geopolitics is Taiwan. It's down almost 7% in the past week. And they were closed for a couple of days because of a typhoon. So for me, in the big picture, just as from a currency perspective, I know that if I have a basket of international stocks, my currency exposure could be worth a third of the total return. And if I have a basket of international bonds, currency could be 2/3 of the return. So I still think that the diversifying of the dollar investors outside of U.S. stock market is still like an interesting investment idea if you believe that the dollar is going to fall. And so I think the willingness to diversify should be partly a function of what you think of the dollar. And I think the dollar has probably put in some kind of long-term peak, and I look for the dollar to gradually trend lower.
Well, Mark, there's a lot of economic news on tap next week, and some of it involves central banks from other countries. We've already kind of hinted at the Bank of Japan, but maybe recap what you expect to see there. And I know there's a lot of other banks in Europe meeting. So what's your outlook on next week's economic data on tap?
Yeah, sure. It's really a busy week. I mean, considering it's the summer, it's an unusually busy week. But the busy week doesn't begin really until Wednesday. And very early Wednesday morning in Tokyo, the Bank of Japan meets. Two issues are at the table. One is about a rate hike. And like I say, the market has moved more towards a 10 basis point rate hike. But there's also a question of what it does with its bond purchases. Right now, it's basically replacing all the issues that it holds that's maturing. So if they announce a cutback in bond purchases, that's going to be a way to acknowledge QT, quantitative tightening. That is to say, more bonds will be maturing than the Bank of Japan buys. I think given the surge in the yen in the past week or so, that if the Bank of Japan does not hike rates, I think we can see a pretty dramatic sell-off in the yen, and that could also prompt intervention. So that comes a very early Wednesday morning. In Europe on Wednesday, the Eurozone will publish their July CPI, and July 2023. CPI fell 0.1% month over month. So if that gets dropped off of the 12-month comparison, the risk is on the upside. A few hours after the Eurozone CPI, there'll be the FOMC meeting. And there, I think the general expectation is what I'd say is a dovish hold. That is, they don't change policy, but they validate or they keep the door open, no pushback against the market's expectation of a September cut. And then a few hours after the Federal Reserve meets, the following day, we've got the Bank of England meets. And the market has been moving back and forth, but right now there's just a little bit less than a 50% chance that the Bank of England cuts rates on Thursday. And then comes Friday is the U.S. jobs report. And it looks like the early estimates have been shaved a little bit. And we're now looking at something about 175,000 on the median in Bloomberg survey. And that comes with unchanged unemployment rate, 4.1%, which if it does tick up, people will be concerned about that SAMS rule, which is basically where the 3-month average is compared to the low print in the last 12 months. So bottom line here is if the unemployment rate ticks up, even one tenth of a percent to 4.2%, it might trigger Sam's rule, which is also one of these recessionary signals. The other thing, wage pressure looks like it's going to moderate too. So we got a really busy week next week. Bank of Japan, ECB, Eurozone inflation, Federal Reserve, Bank of England, and then the U.S. jobs data. And then I think summer's over, or I should say summer's beginning, and the rest of the month, August, looks like a quieter period.
Sounds like some volatility to end next week. Always entertaining when we see that volatility. And boy, oh boy, has volatility been around for the last couple months at least. It does feel like summer, but with that busy of a week ahead of us, traders will definitely be at their desks and it'll give us a lot to talk about to wrap up next week. So, Marc, thank you.